All right, so we're taking a look right now at our finance sector, and the question at this point is BMO or BX, and so you see them highlighted there. Just very quickly, BMO is at a purchase price of $82. I try not to look at the actual price because it doesn't really factor into the performance of the company or future performance. However, um, price matters, right? We'll be able to purchase more shares at a cheaper price. And so, TD Ameritrade right now is at 60. And so if we purchase BMO, we won't be able to purchase as many shares. But again, try not to think of that too much, but it matters. The dividend, BMO is at 3%, BX is at 6%. As far as I can tell, BX isn't having any trouble making that dividend payment. They do, of course, use a lot of debt to do their business. That's just part of what they do. They borrow money and make money with it. So their debt is pretty high. But like I said, as far as I can tell, they haven't had any problems making that dividend payment. So I'm going to go out on a limb here and say that it's fairly safe. Um, PEs are about the same. This initially bothered me. This high of 77.2. Typically, when the PE gets up that high, it's because the price either went up just a whole bunch, or for some reason there was less shares or something like that involved. In this case, over 2016. For whatever reason, I haven't been able to ascertain that yet, but the PE ratio shot up really high for like 1 year. But historically, the PE ratio has been about 14 for years past. And I went back and I looked 5 or 10 years out, and it was only that high. Um, like I said, for that 1 year in 2016. Not quite sure why yet, but that's what's going on there. So these are the lows. Not much difference. Like I said, they're both about the same place. BMO is a bit more expensive, just relative to what their low has been in the past. Can't pay attention to this average PE because, like I said, that was kind of just an absurd thing. Um, Going down the line here. We can't pay any attention either when comparing these two companies, just because they do different things, right? Blackstone is an investment bank, so their net profit is going to be high just because they don't put in a lot of money to make money, right? Versus BMO, which is a bank, there's a lot of branches and a lot of things you have to pay for the individual customer and things of that nature. So we can't really pay attention to that stuff, unfortunately. Same thing here with the cash and share. BMO is going to be a bit safer as far as cash flow goes, simply because that's their business. They bring in cash, right? And they have a lot of it. Blackstone, like I said, they deal with a lot of debt, so there's a lot of loans and things of that nature. This is important though. This is the short interest. This is how many people currently are betting on this stock losing money. And right now, Blackstone is literally double what BMO is, and so that says something. It does. It says that when this thing falls, it's gonna fall. And when it rises, it's gonna rise. So we'll go back and look again at the history, the price history of Blackstone, just to make sure we're okay there. This gets into our alpha score. So BMO performs better when the market is up, but as you can see, relative to the rest of um, the banks, it's they're all kind of bad, except for this guy over here. Up moves. Okay, so remember, this is when there is a lot of activity, when there's a lot of people buying and selling. This stock tends to move up 19% of the time. Blackstone tends to move up 30% of the time. Down moves, again, when there's a lot of activity. This particular stock tends to move down 15% of the time. Blackstone 61% of the time. And so that kind of gives you the volatility of this thing, right? I mean, look at this. This is almost 100% of the time this thing is up and down a lot, right? Versus BMO, which doesn't move around a whole lot. Beta, of course, our beta with Blackstone, it's much better. And BMO beats out Blackstone average monthly return. Volatility, this is what we're talking about right here. Blackstone 14%, BMO 8%. And so that just goes to show you how much this thing moves around. It moves around a lot. And looking at some of the other companies in the finance sector, you see 14 is high. It's high. And so the question simply becomes, do we take the bigger risk, right, on getting a higher return, or do we take the lower risk on the lower return? And conversely, historically, an actual better average return. So that's kind of what we're looking at. Now, going back to our table here. It's wrong table. Where's my table? This is my table. Just need to blow it up. Going back to our table here. We're going to go down to finance. Blackstone there. BMO here. Let's go ahead and get rid of these. Alright. So Blackstone is our MVP. Okay. Why is that? Well, that's because the alpha, let me double check here. That's because the alpha standard deviation, I believe, has consistently been the best performing portfolio. Let's see. CBX is here on this one, and the best performing portfolio right here. Best performing portfolio 171. Is our beta. Okay. Let's go down here. This portfolio, best performing, dividend, beta, and up. There we go. All right, let's find out where else BX is. BX is also, so we got it 4 times. Here we go. Oh my goodness, just in a row like that, right? Best performing, let's see, I'm gonna say it's 586. Gotta be. Oh no, look at that. 12. So BX is in that dividend. So yeah, because that high dividend. I mean, it has the largest dividend of all the finance stocks. So you know, when it's good, it's really good. When it's good, it's really good. My concern is how bad is it when it's bad. That's my concern. So let's look at our history here. All right, now we know that the average, it's great, okay? And what we're comparing here is BX and BMO. All right, here we go. So Big drop for BX. Big drop for BMO. Big drop for BMX. Big jump. Fairly large drop. I mean, as you can see, and I mean we're going back a couple years here, and so yeah, see this? I mean, what you're seeing is, I mean, when it's bad, it is bad. You know, there hasn't been a drop like that in BMO at all, ever, for the last 3 years. That's 15%, another 15%. Now, being that these are fairly close together, okay, being that they're fairly close together, I can assume that there may have been something going on back in 2015, 2016, which caused this issue. It probably has something to do with why the PE ratio jumped up to like 70 as well. That's something that would take a bit more research going back that far to figure it out, but I think it's worth looking at, honestly. So as of now, I'm looking at taking the bigger risk on the larger volatility on Blackstone in this particular market because of the interest rates, because as interest rates increase, as the economy does better, this thing is going to continue up. Also, Blackstone is heavily investing in India, so that's one of those emerging markets that is developing and getting better and better. And as we all know, a lot of times the smaller developing markets have higher rates of return because of the higher risk. Do I foresee any major issues in India? No. However, I don't keep up with India as much, so that's something to be looked into. BMO, you know, boring regular bank, you know, but it's a Canadian bank. Love those Canadian banks, right? So we're talking about residential mortgages. We're talking about, you know, cash deposits and CDs and just the simple things like that. I did look through the numbers. Not spectacular. Nothing to really talk about. They did purchase a fixed income investment company here in the United States. So we're talking about a company that's going to sell fixed income securities to people. So we're talking about, you know, annuities and CDs and things of that nature. So, you know, they're making moves, but not great big giant moves. And that's reflected in the price movement. So it's always tough, isn't it? Always. I say, barring any weird news I come across as far as India is concerned, looking back to find out exactly what happened here in 2015 and 16, make sure it's not any you know, weird thing that can rear its ugly head again. I would say go with Blackstone. You know, again, it is an MVP, so you can't discount that. You can't discount the fact that it has a great beta, which, like I said, it's going to give us that protection and defense that we need if the market were to come down, which, like I said, we're sure it will at some point, right? BMO, it does well. It's not a bad company, you know. Blackstone just has a little more oomph to it. So, like I said, I'm gonna check on 15 and 16. I'm gonna take a look at India. Barring all else, we'll go with Blackstone.